Hello, Tio and Jans. Hi, Leonard, Bill, Farhan, and everyone. Thanks for being here. All right. Welcome to another webinar provided to you by OptionSlam.com. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors. We are not registered investment advisors. We do not provide investment, nor do we provide financial advice, nor do we make investment recommendations. All information, simulated trades, everything presented in these webinars is for educational purposes only. I am Marco. This is my email address. Please feel free to give me a holler, shoot me a message, ask me a question, make a comment. I can even take constructive criticism if you've got it to dish out. Today's topic is the long straddle. The long straddle. What is it? Buy one at the money, put. Okay? Buy one at the money, put. Buy one at the money, call. You have a long straddle. Pretty easy. A lot of traders come to OptionSlam.com, newer traders, what we call newbies, right? Because they heard about this great strategy called the long straddle, that it doesn't matter if the stock goes up, it doesn't matter if the stock goes down. You can win either way. This is very true. That's what the long straddle is for. And earnings is a catalyst that causes stocks to move. Stocks move big on earnings events. Not all stocks, but most stocks have their biggest moves, their biggest 1 day, 1 week, even 2 or 3 week long moves due to what they reported at their earnings release. In other words, that event where they released their earnings from the most recent quarter's earnings, profits and losses, or earnings. Quickly, for those of you who haven't been here, those of you who have heard this many times before, but those of you who are newer to OptionSlam.com, I think of earnings trades in basically 3 categories, 3 different types of earnings trades. It's real simple. There's the pre-earnings trade. That's the trade that you put on days or weeks or even longer before an earnings event. Most pre-earnings trades are put on with the intent of closing them before the actual earnings event. Then the most popular, or at least the most talked about earnings trade is that I refer to as the through the earnings trade. And that is a strategy that you initiate right before the earnings event. And then you close it sometime after the earnings event. So you're playing for the move. You're playing for that big move. Whether it be, or maybe you're playing, you can do a through the earnings trade where you're playing for a muted move where you don't think the stock is going to move very much at all. You know, you might sell a iron condor. Got some emails here recently from quite a few traders trading iron condors. We've had a lot of different webinars about iron condors as an earnings trade. But regardless, through the earnings trades are those trades that we put on right before the earnings event, and then we take it off sometime after the announcement is out. Whether it's immediately the very next morning or the end of the day one day or the end of that week or the end of that month, that's going to vary amongst traders and amongst your different your variety of different trading plans and how you intend to manage the trade. And then there's the post earnings trade. That's that trade in which you wait until after the earnings event. You wait until after the earnings are out. You see which way the stock moves, and then you either go with that move or you fade that move, trade against that move. But at least now you've got some direction. You know what the market's reaction is to the earnings event, and you can trade with that added information now that the news is out. A lot of ramifications to each of these trades, and most of them have to do with implied volatility. We'll touch on that today. The long straddle as a through the earnings release trade is the topic of today's discussion. We're not talking about a pre-earnings straddle. I've done webinars on those. If you look into the archives at OptionSlam.com, go to the resources tab at OptionSlam.com and scroll on down. You'll find quite a lot of webinars that had to do with the long straddle and probably as well as the short straddle as pre-earnings trades. But that's not today's topic. Today is through the earnings release trade using the long straddle. So what is attractive about the long straddle as a through the earnings release trade? What is attractive? Well, it's defined risk. You know, there's no question about it. You know how much is the worst case scenario you can possibly lose. That's important. You can design the trade to lose. You can, to have the risk to lose as much as you want, as much as you're willing to risk. Okay, so that's important. And not only is it defined risk, but it's undefined or unlimited reward potential. Sky's the limit. Or if your stock goes to the moon, I guess you're even beyond the sky. And sometimes that happens. But what is the downside? Low probability of profit. And the reason I say that is because options are priced to perfection. Options are priced based on a pricing model such as the Black-Scholes, and they are priced to expire worthless by expiration day based on a standard bell curve. So the way options are priced, I'm sorry, excuse me. Let me get a drink here. Is based on a standard bell curve. If you were to look at the a one standard deviation, options are pretty much designed to expire inside of that one set. At the money calls and at the money puts are designed to expire inside of that one standard deviation come expiration day. let's take a look at what I'm talking about in Thinkorswim. And we'll go out to the June 15's. CRWD CrowdStrike is reporting, I believe, today after the close. Is that right? Let me see. I've got that on my other screen. Yep, today after the close. So this one is in play. A lot of hype. Go out to the June 18th and let's buy a call and let's buy a put. And take a look at what this looks like. All right, so let's buy a put over here. And I'm going to hold my control key down in the Thinkorswim platform and buy a call over here. So for $19.85 times 100, $1,985. Okay, so you can risk as much as you want or as little as you want. Well, if you want to risk less than $1,985, you can't make this trade because that's what it costs for one contract. Okay, now, not all straddles are going to be this expensive. If I would have chosen a shorter time frame, then we would have had a shorter, a smaller. Let's choose the options that expire in 1 day. That's going to be a little more affordable of an option of a straddle. Let's just to illustrate that. That's going to be $13.65, $1,365 for a straddle that expires tomorrow. Did I use the right strike here? 215. I should have used the 217. Let me bump this up to the 217.50. That's a more appropriate strike. Let's do the 217.50. And doesn't change the premiums very much because we're very close to at the money when we were looking at the 215. But this is more appropriate with the stock at 217. Now we're using the 217.50 strike. So let's just look at one of these straddles at a time. And this one is the options that expire in 1 day. And if we look at the risk profile of that, and this is actually wider than the, let's see, if this is this out to 6.5. Yes, it is. Okay, so this shaded area is the 1 standard deviation, and the straddle pricing takes you out to your break evens are beyond 1 standard deviation. So in other words, there is a let's do it this way. Let's put these let's set these slices to 1 standard deviation. There we go. No, 1 standard deviation. Oh, I didn't mean to do that. I meant to set those at. What I want to do is I want to set those slices to break even on expiration day. Okay, that's what I meant to do. All right, so now what we have here is we have 1 standard deviation, okay, and we have the break even of the straddle. So so this is actually worse than what I had verbalized earlier. I said that now if I just look at one side or the other, okay, let me do that. Let me break this down to a call and a put. All right, let's break this down. Let's just look at the call. All right, let's just look at the call without, and I'll model in the put too, but I'm doing them separately now rather than as a straddle because I want to go back to my point of what the probabilities are here. All right, so looking at just the call is priced to, you can see where 1 standard deviation is, and the call is in the break even on the call is slightly inside of 1 standard deviation. So it's not perfectly at the 1 standard deviation as I had verbalized, okay? It's slightly inside. Let's look at the put. Now the put break even is very close to 1 standard deviation, the break even, that little red hash mark. And this goes to a topic that we're not going to get into today, maybe in the next webinar. We don't have time today, but this goes to a topic that is relevant to straddles, and the topic is skew. It's put call skew. Puts are priced higher than calls usually. Most of the time, puts are priced higher than calls at equal distance space away from where the stock is trading. So if you go out $10 away from the at the money to the call, and you compare the price of that call to going out $10 away from the price of where the stock is trading of the put is going to be more expensive. Generally speaking, goes to a topic. Generally speaking, in other words, it's not always true, but most of the time it's true. All right. So back to when you do both of them together, now you're paying for a put and a call, puts your break evens outside of that 1 standard deviation. And I'm going to go back to using the straddle because it's priced a little bit less than these individually when you do them this way. And let's look at the percentages. There is a held to expiration day, which in this case is the end of the day tomorrow. Held to expiration day, there is a 89.6% probability that price is going to be between this red hash mark and this red hash mark, or the break evens of this straddle. So this is why I say low probability, okay? Now, having said that, I want to show you some work that I just did on this stock when the stock was new and fresh and young, taking us back to July of 2019. Let's just take a look at OptionSlam.com data on this stock, and let's go to CRWD. CRWD. When you go to OptionSlam, you can type any symbol in this upper right-hand corner, click the Go button, and it's going to take you to that stock, and then this black bar turns into a bunch of different links that are all relevant to the stock that you chose. And it takes you by default to the first one on the left, the earnings history page, and then you have other pages you can go to learn more information. And we're going to visit these other pages today. We're on the earnings history page, and we can look back in time and see that the first earnings event was July 18th of 2019. All right, July 18th of 2019. So I used OSBTT, which, by the way, is available to all OptionSlam Insider subscribers, and it's found right here underneath the backtesting tab. The OSBTT is our backtesting tool, and what's cool about it is that you can download the results. Download the results right out of the OSBTT and create your own database of backtests to determine whether your strategy holds water. So going back to when this stock was young, new, it was an infant. By the way, new issues are one of my favorite opportunities to consider a long straddle because, well, we'll talk about that in a little while. But this is when this stock was a new issue. It had just come out. It was just become public. And this was its first earnings event after it was publicly traded. And the at the money straddle on this stock that was reporting on July 18th after the close, just like it's reporting today after the close, okay? You could have bought a straddle on this stock. It was trading at $72 for $405. Now, that's not the case today. We just saw that it's about $1,300 for that straddle. That's because the stock is no longer at $72, and implied volatility has changed on the stock since then. And had you held this, so you can see here's the date, here's the stock price, here's the option value. This is what the straddle would have cost, $405. You see, no, in this case, I didn't do a straddle because the stock was at $72.75, and the only strikes available were the 70 and the 75. So since it was right in the middle, I didn't have the opportunity. They didn't offer a 72.50 strike. Okay. So I just used the next best thing, which is a strangle. I used the 70 call, the 70 put and the 75 call. Okay. It's essentially almost the same thing. Yes, definitely there are some differences here, but it's the best I could do to illustrate the points that I want to make here. All right, with this particular stock. All right, fair enough. All right, so let's take a look. Now, that's if you would have bought the straddle that expired the next day. Now, I want to compare that to, we're going to talk about this in more detail, but let's compare that to you don't have to buy the straddle that expires the next day. You can buy the one that expires the next month. In this era, CrowdStrike did not have weeklies yet. You had your choice between the Julys, the August, the Octobers, or the following January 17th. Only monthlies were available. There were no weeklies available at this time. So let's take a look if you would have gone out and bought the next month out. The August 16th, the options that expire the third Friday of August. And in this case, it would have cost more than double. Okay. The 1 day trade was $400. What was it? $405, and it doubled, more than doubled. There was $447 of profit. So you made over 100% on your money. Here, if you would have gone out a month, seems like a bargain. I got a month of time I can buy for just a little bit over double the price of the 1 day option. That almost seems like a bargain, doesn't it? If you want to relate it strictly to time. But the 1 day profit on that was not 100%. It was only $207. So this is, however, had you held all the way to expiration day, you would have doubled your money. Okay, more than doubled your money. Again, in this case, in fact, there was an opportunity right here where you could have doubled your money rather early on when the stock hit $94. Okay, went up from 72 up to 94, was a substantial increase in price and exceeded those boundaries that I just illustrated in the risk profile, where I was illustrating why straddles have a low probability. But here's one that defied that low probability and actually blew out and was profitable. Be careful though, if you go out too far in time, now you're paying $1,700, and you need to find a place or a time when you can lock in profits, and it's hard to know when that day is. So you need to develop some rules around your trade, because if you hold it too long, you can find yourself on the downside or negative, okay, losing money. And this one came back to actually provide a profit at the end of 66 trading days, 2 months out, basically. And then one final example is the leaps out to January. I don't know if you can legitimately call them leaps at this point when you're trading in July, but They're commonly called leaps when you're looking at the Januaries. But anyway, $2,300 is the investment. Looks like profit all the way through, okay, until price came back here, close to where it started, okay, and then that was a big drop there, $86, and then all of a sudden you're up $250, and by the end of the day, the next day, you're down $365. So this all goes to trade management, okay, trade management, and we're going to talk about that. Not today. Don't have time. But in the next webinar, I will talk about how to manage these trades, lock in profits, minimize risk, and other topics related. All right, so back to PowerPoint. Options are priced to perfection. I think I tried to illustrate that by showing the risk graph of a straddle and how options are priced so that there is a high likelihood that price will end up between these break-evens come expiration day. Now, if you get a move sooner than expiration day, that's where you can get profit and lock in profit on a straddle. To hold a straddle all the way to expiration day is probably, usually, not the wisest decision. Okay, so you need to do some back testing, and I've got another set of back tests to show you that I did on another stock that's coming up. All right, so that's a good question. How to find the stocks that are coming up. I'll just quickly show you how I found the stocks that are coming up. Simply use OptionSlam.com. I go to the stock screener, okay? I go to the stock screener, and I've got all these different saved screenings. You can save your own. You just go through the filters here and decide which filters you want. I start out with this one, and then I customize it. My generic one just has a few filters. It says, what stocks are reporting earnings within a week of today? And what stock, I only want to see stocks that trade weekly options because those are the most liquid options. Those are the most liquid, those are the stocks that have the options that are the most liquid. And you can set this however you want, but I'm just going to show you my quick generic scan. And it's stocks that trade at least $20. And I don't have a maximum over here, but I could say, well, I don't want to see stocks that trade over $100 or whatever number. You could put a maximum number over here. I got 2 million average daily volume just to filter out those low volume stocks, the stocks that don't have a lot of liquidity. And basically that's all that I have. I ignored all these other filters. These are all filters for other purposes. Last webinar, we focused on the last webinar, we focused on this section right here. That was our main focus in the last webinar. So you can go to the resources tab at OptionSlam.com and go to the archived webinars to see old webinars, okay? But anyway, this is the quick scan I did, and it came up and says, okay, within a week of today, the stocks that are going to be reporting earnings that are over $20 in price and trade at least 2 million shares of volume per day, et cetera, those few little criteria. Here's where I found CHPT and CRWD. We also have DOCU, which is also a newer series, a newer stock. It's not been on the market a long time. Now, GameStop is, everybody knows about GameStop by now. If you didn't know about it 6 months ago, you know about it now. You got Marvell Technologies and you've got Slack Technologies. I always want to think of that one as Workhorse, but it's not. That's a different symbol altogether. Okay, so and then you can see that these let's look at this column, EVR, earnings volatility rating. EVR, these stocks, that EVRs are, that's a measurement that we developed here at OptionSlam.com, where we rate every stock for its volatility based on its earnings announcement. So what we do is we look at the last 12 earnings announcements, and we look at how volatile that stock was. What was the reaction to the earnings announcement? That immediate reaction, the 1 day reaction. So, for example, here's one with a 6.3, and if we right click on that and open that in a new tab here, we can go to the earnings history page of that stock, and we can see that it had a big move, okay, a big move 1 day after the earnings event. The maximum move, it moved 15% that day. But by the end of that day, by market close, it was still a big move, but it had lost about half of the max move and settled in at down 8.51%. Okay. Now, that one, let's go to another one that has a higher EVR. Okay, so we got CrowdStrike has a high EVR. Also, let's do that one because that one's got a few more earnings under its belt. Let's right click on that and open link in a new tab. This pop-up gives us some of that information, but I like to go right to the earnings history page so I can see all of the information, okay? And that pop-up only gives me the last 4 earnings events, and many stocks have 20, 40, 60 earnings events, okay, that we have records of. This one only has about 8 or 9 here, but you can see that these are big moves. 13% by close, 17% by close, 14, 12, and look at the size of these moves, the maximum move inside of 1 day, 18%, 24%. These are huge 1 day moves. These are the kind of moves that can possibly make the long straddle player some profit. This is what it takes to make profit, is a large outsized move. Okay, you need that big move. Otherwise, you're going to be in this zone in between the red break evens. Okay, we'll talk about all of these things. Moving on. What is the number one enemy of the long straddle as a through the earnings play? Anybody? Please type in the chat box there. What is the number one enemy of the long straddle? I know a lot of you know the answer to this, and some of you may not. Thanks, Bill. Yep. Johns? Yep. That's true. Decay due to what, though? Aaron? Very good. Leonard's got the answer that I was looking for. And Tio says theta. So time decay. So all of these things are working against you. Thanks, everybody, for your great answers. Bill says volatility, and that's absolutely correct. Time decay, theta decay. Thanks, George. Those are enemies. But yes, because buying long options, you're subject to theta decay. You're subject. Aaron says, I hope I say your name properly. Maybe it's Arun. I'm not sure. I apologize. I should know better. But no move in price. What if the price doesn't move? That would be a bad thing. And if the price doesn't move, volatility is going to dissipate terribly. But even if the price does move, the number one enemy of the long straddle, in my mind, is implied volatility crushing. Implied volatility crush. what's commonly referred to as IV crush. And I am gonna put this out there. I should have worded this differently, because I say, what do you think the number 2 enemy of the long straddle is? And my answer may not be the best answer. Some of you who just said time decay, no movement in price, theta, John's has my answer. What I put up here as the number 2 enemy is IV build. Okay, so I don't know that that's number 2. I would say all of those items, all are enemies of the long straddle as a through the earnings strategy. Okay, and we won't go into all of those, but the number 1 that I do want to illustrate quickly is the IV crush. So let's go back to Thinkorswim again, and let's go back to, let's see, we have, let's go to, this is crowd. Is this crowd? Yeah, this is crowd. Okay, so this is CrowdStrike. Let's go back to the last earnings event, the most recent earnings event, March 16th. That other back test was this very first earnings event back in 2019. I didn't back test all of these, okay? I just was trying to illustrate a certain point, so I wanted to get that out. But let's look at IV. Let's look at implied volatility, March 16th after the close, and we'll go to CrowdStrike, CRWD. We'll go to Think Back, and we'll set our date to March 16th, and this is the day that after the close, they're going to report their earnings event, March 16th after the close. And over here is the implied volatility of the different option series. So here's the options that expire in 3 days, the options that expire in 10 days. At this point now, CrowdStrike does have weeklies, okay? In our back test example that I showed, it only had monthlies. It only had these ones that were the 3rd Friday of the month, the April 16th and the June 18th, etc. But now it does have weeklies. It is an in-play stock, and this is the corresponding implied volatility that is affiliated with each of these certain expiration cycles. So I'm going to just let's do it this way. Let's use the old snipping tool. Let me squeeze this down so we can see this here. All right, let's do that. So now we've got that picture. We'll set that over here, and then we'll go forward in time to one day, the next day after the earnings announcement. Implied volatility went from 112% to 78%. And in the March 26 options, those options that expire a week out, IV went from 77% to 61%. And those options that expire 2 weeks out, IV went from 70% down to 58%, etc., etc. Okay? And then the further out in time you go, the less effect there is in that IV crush, what we call IV crush, okay? Because these options, if you go way out in time, now these options have other earnings events. There's going to be another earnings event. Let's see, July, March, April, May, June. So July's are pricing in another earnings event that's going to happen in June. Okay? Actually, it's going to happen today after the close. So this option is not going to crush as much as the options that are not affected by the next June earnings event. Okay, remember, we're back here in March 17th. All right, is this making sense, folks? Are you following me? Okay, this is an IV crush. It affects all these options here more so than these options here, because these options have more earnings events that are going to affect them. So let's look at this one. 55 in the July 16s only went down to 54. You follow? You see that? Hardly dropped, but it did drop. And that was just a one-day effect. And IV continues to crush beyond one day. If you go to the next day, 2 days out, IV continues to drop. And this is an effect of, here's the options that were at 112 over here are now down to almost nothing. Okay. IV crush, why is that the biggest enemy? Because implied volatility is that item that is built into the Black-Scholes model, all pricing models, not just Black-Scholes, into any options pricing model, which has a direct relationship to time. Yes, so all of you that said time is an enemy, you're right, but implied volatility has a direct relationship to time. So the further out in time, generally the higher the IV, except when it comes to binary events such as an earnings event. That's when IV starts building as we approach the earnings event. And that's why I say the number 2 enemy is IV build. So going back to the, and let me explain that now. All right, so what we did here is we looked first at the crush. Now what I want to point you to is the IV build as we approach the earnings event. So let's go back here. The earnings event was on March 16th, I believe. Yeah, March 16th, right? Yeah. And so let's go back, I don't know, a couple of weeks to March 1st. Let's go back to March 1st and let's see. And I didn't, let's see. I'm trying to spread this out just a little bit so we're not distracted by what's in the background here. Well, come on back, Thinkorswim. All right. All right, so we're going back to March 1st, about 2 weeks ahead of the earnings event. Okay, and implied volatility goes into the valuation of options premium. Okay, so what is options premium made of? It's made of it's made up of it's a few things that are taken into consideration is where is the stock priced? What strike am I looking at? Am I looking at the money strike and out of the money strike and in the money strike? How much time is there to expiration date? Is there 4 days, 11 days, 18 days, or 46 days, or 137 days? So time. And one of the most important things that affects option premium is that esoteric thing that we call implied volatility. And the higher implied volatility goes, as implied volatility rises, options premiums get more expensive, both puts and calls. As implied volatility goes up, option premiums increase. 2 weeks before the earnings date, IV was 51. Let's just look at this top line, because these are the ones that are most affected by implied volatility. Although these further dated options are also implied, they don't build as much in IV, but they have higher vega. Maybe we'll get into that in the next webinar, the vega factor. In fact, I'm sure we will. So let's take a look. Let's move forward here. 51, we're starting out at 52. Go forward to Tuesday. We're at 55 already. We're at 65. Jumps to 86. What we should be looking at is the March 19s. Let's look at the March 19s. Let's focus on those, because those are the options that expire after the earnings event. That's what the ones we should have focused on. So I won't go backwards on this. I'll just change our focus now to these regular monthlies that expire March 19. These are the ones that expire after the earnings event. So let's continue on. They're 82. We're going to start out. We're starting fresh here. 87. Through the weekend here. Now they're up to 91. Implied volatility is building. This is what I call IV build. They fell back a little bit to 87 on that day. 92 came right back to almost 93. 311 now. We're getting to be the week before. We went from 93 down to 89, 90, about 90 there. Came back just a little bit. Holding pretty steady at 89. Moving forward, the 13th, and now Monday, the 14th. 80, still holding there right around 89. Boom, we get to the 15th, the day before the earnings event, and they bounce up to 109% implied volatility. This is what I call why is that an enemy of the guy who's trading the long straddle as an earnings play? Because generally, you can't put this trade on, you can't put an at-the-money straddle on until you know what the at-the-money straddle price is going to be. What strike is going to be the at-the-money straddle? You can't put this on 2 weeks ahead because the price changes in that 2 weeks. And if you put the straddle on 2 weeks ahead, first of all, that's not a through the earnings trade. That's going to be a pre-earnings trade. And can you put that trade on 2 weeks ahead and expect that because of that IV build that you can see profit over the next 2 weeks? The answer is usually no, because we have all those other things that you guys brought to the table that are working against the long straddle, primarily theta decay. So yes, IV build increases option premium, but the theta decay is working against that increase all the time. So there's a double-edged sword there. In the through the earnings straddle, we need to determine a few different things. What strike? That's easy. It's the at-the-money strike. Which expiration cycle? That's not so easy. Do I choose the shortest duration, a longer duration, or and just how long? And should I choose weeklies or versus monthlies? These are all considerations that the long straddle player needs to take into consideration. Which stocks to buy straddles on? I want to propose that new issues are something that deserve the attention of the trader who's interested in risking at the money straddle as a through the earnings trade, because companies that are new issues They haven't been on the market very long. The market players don't have a real good feel for that company yet and how that company is performing and whether that company is going to have stellar earnings reports or failed earnings reports. And it's the trading public just doesn't have a feel for the company yet. Therefore, they get it wrong often. So new issues is something to consider. Stocks that have a history of moving big. So you can use OptionSlam, that screener, to find stocks that have a history of moving big. Stocks that have a news catalyst, stocks that, there's something going on in the news lately, and you believe that could affect the trader's reaction, the market's reaction to the earnings event coming up. And another thing to look for is stocks that are priced with stocks that have low priced straddles. So all of these things are things that you can, not all of these things, Catalyst does not, we don't report news at OptionSlam, but history of moving big is something you can screen for. And you can also look for, in our data, for stocks that have a lower than usual, their straddle price is lower than usual. I'll show you how to do that here in a quick second. And stocks just basically that you believe have a chance of moving big on an earnings event. So before you risk your money in a long straddle, I would encourage you to use the OSBTT and back test that strategy on your stock just to get a feel for what has happened in the past. And use the OptionSlam stock-specific pages for a cursory assessment. So let me show you one more set of downloaded statistics from the OSBTT. And this is another stock that came up on our screener. This is ChargePoint. This is very new. I think this has only got, let's see, let's go back to our screener and let's go, here's our screener's ChargePoint was one of the results in our screener right here that we did our generic screen. And by the way, you can save your screeners too, simply by selecting the criteria that you want to select above, click save, give it a name. I named this one that we're looking at, the generic. And then I already did this. We went to ChargePoint and we found out that they've only had one earnings event so far. Okay, so what I did is a set of back tests. Oh, that's the crowd. We can close that one. And let's see, where's this ChargePoint one? Here's ChargePoint. And so what I did with this one is I did a very similar thing. I did the options that expire in 1 day, the options that expire in a week, the options that expire in 2 weeks, 3 weeks, 4 weeks, and 5 weeks, okay? That's what we have here. Let's take a look. ChargePoint, $331 for the straddle. Buying the options that expire in 1 day, net out a loss of $65. You're only able to sell that straddle by the end of the day, the next day, for $266, okay? And by the way, it's important that you close this trade because one option's in the money, the other option is not. And an in-the-money option will go into auto exercise. It will be automatically exercised. Any in-the-money options will get automatically exercised. So if you don't close that option, you will be long that stock if it's the call that's in the money. In this case, it was the put that's in the money, so you'll be short that stock. No, wait a minute. They're going to, it's the put that's in the money, so you went long a put. So you put that stock, you're gonna exercise that stock, you're gonna be short that stock in your account. So the point is that you need to close your any in the money contracts need to be closed, and of course out of the money contracts are going to expire worthless. Okay. So in this case, let's see, it was the 3050 put. It expires in the money. So you are long that put, so you're going to put that stock to somebody else, and therefore you're selling that stock at $30.50. You're going to be short that stock at $30.50, and that's how the exercise process works on that. So let's go to the back to the options view, and that is the options that expire a week later. These were underwater for a while. There was an opportunity for a $94 profit, and held to expiration day, $55 of profit on a $644 risk. Okay, so if you apply a formula there, you could say equals this sell, this profit divided into the risk, and the answer is in percentage terms, a 9% profit against risk. Okay, 9% profit against risk. Let's copy that formula a quick minute in case we want to use it again. Here's the highest profit available. Now, how do you know if you're going to, how do you know when that, whoops, that didn't work. Let's back that out and paste that formula there. 34% profit against risk. I just pasted that same formula in there. Okay. All right, etc., etc. Let's move back to OptionSlam.com, and I'm going to show you how to assess the likelihood of your stock being a good candidate for a long straddle through the earnings straddle. And there's a few things that we can look at here. So let's take a look at our results. CHPT, there's not a lot of history there. AVGO, let's take a look at AVGO. Is that a candidate? Let's open that in a new tab. That takes us initially to the earnings history page. And I can just do a cursory look here at these two columns. What kind of moves does AVGO have? 3%, 5%, 8%. The biggest move I see on the screen is 11% max move, and 8% by the close of the one-day move. These are yeah, they're big moves. You know, that's a stock moving 3 to 5 and even 8% in one day. Yeah, but big moves, but not anywhere near what we saw in CrowdStrike or ChargePoint, right? Therefore, AVGO sports a EVR of only 2.1, where CrowdStrike sports an EVR, okay, of 5.7. The highest EVR you can have is 10, and very few stocks are up there. And if they are up there, they don't stay there long after they're only there in their initial first few earnings events. Then things settle down as the marketplace gets more familiar with that stock and more familiar and knows better what to expect out of that stock come an earnings event. So AVGO, I'm going to skip some of these other pages because I want to look at some other stocks for the cursory review to see if a stock is something that we should consider as a candidate for a long straddle. So let's go to the post-earnings page of AVGO. Simply by clicking here, we're still on the same stock, and scrolling down to this table. Now we can see not just the one-day move, but now we can see what happened to this stock, you know, out in time, 5 days later, 8 days later, 13 days later, and as far as even where does that earnings event start to fade and no longer seem to be relevant to how the stock is behaving anymore. And in this particular example, I see that stock continued to move upwards into 13 days past the earnings event. By the way, this is calendar days, not trading days. The OSBTT, the OptionSlam backtesting tool, refers to trading days. This particular tool refers to calendar days. There's reasons we made these decisions to display things in different formats like that because of different strategies that in some strategies calendar days is as important because, right, theta decay, if you think about it, theta decay means how much my option is going to deteriorate as time passes, how much my option premium is going to deteriorate as time passes. That's theta decay. And guess what? Theta decay happens over the weekend too. So OSBTT only is concerned with what's the end of the day profit or loss on trading days, because the market doesn't trade on the weekend, so you can't really, the calculation is going to be the same on a Saturday or a Sunday as what it was on Friday. So there's no sense in posting that on the OSBTT. So that's just quickly one of the reasons. So AVGO, let's jump back over to CrowdStrike, and let's do a cursory assessment of that one and see if that one's worth considering to look at for a possible long straddle through the earnings event. So this page is interesting. I've got some good information here. I can see that this stock oftentimes moves big. In fact, the smallest moves I see here are 7% max. But now I need to go one step further, and I need to go to the implied move pages at OptionSlam. Implied move weekly and implied move monthly. I need to go to the implied move pages because this is going to tell me whether the straddle was priced expensive or priced less expensive compared to the norm. All right, the norm for this stock. And there is no norm that goes across all stocks. Every stock has its own normality. Okay, every stock has its own personality. And we'll scroll down to the table here, and we'll see that this set of data here is what is the implied move as we approach the earnings event. Okay, and we keep track of the opening implied move, the highest implied move, the lowest implied move, and what was the final closing implied move. Finally, the last capture of implied move pricing right before the earnings event. And if you want to see the details of all of these and where they come from, you simply click on a choose this earnings date and click on the submit button, and it will bring up a new table of data that shows you where these details came from. Okay, but we just sum it up for you here, showing you that the open, high, low, close, and we actually illustrate that in a chart for you. Also, these candles are showing, here's the March 16th earnings event. The open implied move was up here, and the final implied move was down here. And this is an illustration of also why I said earlier that most of the time you cannot count on implied volatility increasing to increase the value of your option straddle. Okay, because usually implied volatility is overcome by theta decay. So the at-the-money straddles, here's an occasion where the at-the-money straddle actually got more expensive as we approach the earnings date. But in most of these examples, you can see that the implied move, therefore the implied volatility, was not enough. The implied volatility build was not enough to keep up with the theta decay, and the at-the-money straddle actually got cheaper as we approach the earnings event. That's what's illustrated here. Again, if you want to see the details of that, you would just choose an earnings date from down here and choose it from the drop-down, submit, and open up another set of data, a whole new set of columns. We don't have time to go into that. Back to the cursory look. What is the norm implied move for this stock? Well, this stock is pretty young. It's just a juvenile. It's not an infant anymore, but it's still a juvenile. It's not an old mature stock that's been around for years and years and years, only since mid-2019. And the implied volatility started out, the implied move started out at about 9%. This is the lowest implied move on the board, and this was last quarter. And the implied move right now, the current weekly implied move right now, is 6.14, even lower than the lowest one on the board. Therefore, I would consider this to be a candidate based on a cheap at-the-money straddle price, based on the information. Now, that information is here, and I'm going to go ahead and open up that table a minute so that you can see where this 6.14 comes from. Okay, that's the last capture. And if I submit this, click that submit, now I got this new table that opens up where we have been capturing the price of the at-the-money straddle since May 7th. Okay, since May 7th. Almost a month now, we've been capturing the at-the-money straddle price, and it started out at 11.77%. It went up to 12.38%. I'm not going to get into all the details of this table, not today, maybe in the next webinar. And then you need to look over here to see if there's even a higher one. That looks like the highest IV. So it actually went up to 12.38% at one point, but it has come down now to be, I'm looking for, it must have been last night's capture. I don't see it on the board. It must have been last night's capture that is not published here. Yes, it must have been last night's capture that's not yet published here. So the most recent capture is 6.14. Let's go check that. Let's go check that and see if that's accurate at Thinkorswim. We'll go to your brokerage, and we'll go in here and we'll look at the front week at the money straddle. This is how implied moves are captured. We're going to go buy that straddle just to price it out. It's $19, and we'll divide that into, let's see, $19 divided into the strike of 200 is, that says it's 9%. That says it's 9%. So there is a discrepancy there. But that's why it's always worthwhile to check and see if that's, so I'm wondering why that is. I'll have to look into that. But it's always worthwhile to check. So 9%, let's go back to OptionSlam. And then I'm going to have to eat my words a little bit here because 9% is not the lowest number. Okay, 8.35 is. 9% is low compared to all these, but it's not the lowest number. All right, so that's one place you can look. And then the next best, okay, you can do the same thing for the monthly. You can do the same similar data is available at the monthly. Go into the implied move monthly page. And now the monthly implied moves are going to be slightly higher, generally because there's more time. Okay, there's more time to those till those expire. So here's similar data for the monthlies. But most importantly, I want to take you to the post-earnings page, because this is where I can quickly assess. Now that I know that the implied move is about 9%, okay, now I can see, does this stock move enough to justify a straddle that costs 9% of the underlying stock? And in this earnings event, it certainly did not. The long straddle, I can quickly see that that stock did not move enough to justify buying the straddle. But in this example, where the stock actually moved within 3 weeks up to 57%, I can easily justify a 9% premium for a long straddle. So how many of these earnings events can I justify? Now you're going to say, well, the 13%, that's questionable. Not to me. To me, that's a losing straddle. The 13% move does not just, even if the option premium implied move was at 9%, which it wasn't. It was higher than that back on June 2nd, 2020. We'll go back to June 2nd and look at that again, just to make sure that I'm. June 2nd, the implied move was 12%, and it only moved 13. Well, it needs to move a lot more than the price you're paying in order to overcome that IV crush, because that IV crush is going to suck the premium right out of your options upon the earnings announcement. Okay, well, I knew that there was going to be too much material to cover in one webinar here. That's why I saved this other topic of how to manage risk in a long straddle, how to lock in profit in a long straddle, how to minimize risk after your straddle's been in play, and you've got a losing straddle. How can you try to reduce the risk in that straddle? And this topic called gamma scalping. So these are all things that have that are all valid topics on the same conversation, long straddle as a through the earnings strategy. Thanks everybody for being here. We'll look forward to seeing you in the next webinar. Goodbye for now, and good trading.